The Psychology of Money. Part 1. The big idea of this book. This book teaches one powerful truth. Being good with money is not about how smart you are. It is about how you behave. You can be a genius and go broke. You can be a simple person and become a millionaire. Money is more about psychology than mathematics. Let me tell you some stories. The Rich Man Who Lost Everything. The author once worked at a hotel. One guest was a technology genius. He had invented important parts of Wi-Fi routers. He had started and sold companies. He was extremely rich, but he behaved strangely with money. He carried thick stacks of $100 bills. He showed everyone. He bragged constantly. One day, he gave thousands of dollars to someone and told them to buy gold coins. Then he and his friends threw those gold coins into the ocean, like skipping stones. Just for fun. Later, he broke a lamp in the hotel. When the manager said it cost $500, the rich man angrily gave him $5,000 and said, "Take it and don't insult me again." He was smart, very smart, but he had no control over his ego and emotions. Years later, he went broke. The janitor who died a millionaire. Now let's meet Ronald Read. He was born poor. He worked at a gas station for 25 years. Then he worked as a janitor for 17 years. Simple life. Small house. No luxury. No fame. When he died at age 92, people discovered something shocking. He had over $8 million. How? No lottery. No inheritance. He simply saved small amounts of money. Bought good stocks. Waited patiently for decades. That's it. He understood one powerful thing. Time plus patience plus good behavior equals wealth. The wealthy executive who lost it all. Now meet Richard Fuscone. He was highly educated. Harvard degree. Top finance executive. He retired early. He was rich. He built an 18,000 square foot mansion. 11 bathrooms. 2 pools. 2 elevators. Huge maintenance cost. Then the 2008 financial crisis happened. He had too much debt. He had no safety cushion. He went bankrupt. His mansion was sold for much less than it was worth. What do these stories teach? The janitor became rich. The finance genius went bankrupt. The tech genius lost control and lost everything. So what matters? Not IQ. Not education. Not background. What matters is patience, humility, emotional control, long-term thinking, avoiding greed. Money is not physics. Money is psychology. Why people think differently about money. Here is something important. No one is crazy with money. People just have different life experiences. Someone who grew up poor thinks differently about risk than someone born rich. Someone who grew up during high inflation fears inflation. Someone who lived through the Great Depression thinks differently about investing than someone who grew up during a booming stock market. Your personal experiences shape your financial decisions. Even if two people are equally smart, they will disagree about money because they lived different lives. The lottery example. Poor people spend more money on lottery tickets than rich people. Many rich people say, "That's stupid." But imagine this. If you are poor, if you feel stuck, if you see no opportunity, if you believe your income will never increase. A lottery ticket is not just a ticket. It is hope. It is a dream. It is one small chance to escape. It may not be mathematically smart, but emotionally, it makes sense to them. That is the psychology of money. Money is still new to humans. Here's something surprising. Modern investing is very new. Retirement accounts like 401k only started in 1978. Roth IRA started in 1998. Index funds are less than 50 years old. Widespread credit cards started after World War II. Humans have thousands of years of experience hunting animals, but only a few decades of experience investing in stock markets. So when we make mistakes with money, it's not because we're stupid. It's because we're still learning. Luck and risk. The two invisible forces. Now let's talk about Bill Gates. Bill Gates went to one of the only schools in the world that had a computer in 1968. Out of 303 million high school students in the world at that time, only 300 went to his school. That's 1 in a million. That was luck. He was smart. He worked hard. But luck gave him a huge advantage. Now here's something sad. His best friend, Kent Evans, was just as smart and ambitious. But Kent died in a mountain climbing accident in high school. Same intelligence, same opportunity, different outcome. That was risk. Luck and risk are always present. They shape lives more than we admit. The dangerous thing about success. When someone becomes rich, we say, they're smart, they worked hard, they made good decisions. Sometimes that's true, but sometimes they also were born at the right time, met the right people, entered the right industry, avoided bad luck. The problem is, we copy extreme success stories. But extreme success often includes extreme luck. So copying it doesn't always work. Better idea, look for patterns that apply to many people. For example, people who save regularly usually become wealthier. People who control spending usually stay stable. People who avoid debt survive crises better. Those patterns are repeatable. Nothing is as good or as bad as it seems. Success can make you overconfident. Failure can make you feel useless. But reality is usually in between. A bad investment does not mean you are stupid. A good investment does not mean you are a genius. Sometimes you were just lucky. Sometimes you just experienced risk. The key lesson: survive long enough for luck to find you. Avoid total destruction. Because if you stay in the game long enough, good things eventually happen. Core lessons so far. Let's summarize part 1. Being good with money is about behavior, not intelligence. Patience is more powerful than brilliance. Your life experiences shape how you see money. Luck and risk play a bigger role than we think. Extreme success stories are dangerous to copy. Survival is the most important financial skill. This is the end of part 1. Part 2: The power of compounding, staying rich, and knowing enough. Chapter: The power of compounding. Let me tell you something that sounds simple but changes everything. Small things, repeated for a long time, create massive results. To understand this, the author tells a story about ice ages. Scientists once believed ice ages happened because of huge, dramatic forces, massive volcanoes or giant mountains rising. But they were wrong. Ice ages happen because of small changes in Earth's orbit around the Sun. Just slightly cooler summers meant snow didn't fully melt. That leftover snow reflected sunlight. That made the planet cooler, which created more snow, which made it even colder. Over time, a tiny change created an entire frozen planet. That is compounding. And money works exactly the same way. Warren Buffett's real secret. People think Warren Buffett is rich because he is a genius investor. Yes, he is very skilled. But here's the more important truth. He has been investing since he was 10 years old. By the time he was 30, he already had the equivalent of millions of dollars. Most of his wealth came after age 50. Almost all of his billions came after age 60. Why? Because compounding needs time. If Buffett had started investing at 30 instead of 10, and retired at 60 instead of investing until 90, he would not be worth tens of billions. He would be, just, a millionaire. His skill matters, but his time matters more. His real secret is not high returns. His real secret is staying invested for 70+ years. Why we underestimate compounding. Our brains think in straight lines. If I give you 8 plus 8 plus 8 plus 8, you can calculate it easily. But 8 times 8 times 8 times 8, that becomes harder. Compounding is multiplication, not addition. That's why people quit too early. They don't see big results in the first few years. So they stop. But compounding is slow at first. Then it becomes explosive. Like planting a tree. For years it looks small. Then suddenly it becomes huge. The lesson: you don't need incredible returns. You need decent returns for a very long time. Getting rich versus staying rich. There are thousands of books on how to get rich. Very few teach how to stay rich. Getting rich requires risk, optimism, taking chances, bold action. Staying rich requires humility, fear of losing, being careful, protecting what you have. These are different skills. Let me tell you a story. Jesse Livermore, the man who won big and lost bigger. In 1929, during the Great Depression, stock markets crashed. Most people lost everything, but Jesse Livermore had bet that the market would fall. He made the equivalent of billions of dollars in one day. He became incredibly rich. But here's the sad part. He later lost everything. Multiple times. He made fortunes, lost fortunes, made fortunes again, lost again. Finally, He took his own life. He knew how to get rich. He did not know how to stay rich. Why? Because staying rich requires survival thinking. You must say, "This is enough. I will not risk everything. I will protect what I have." There is only one way to stay wealthy. The author says something powerful. There is only one way to stay wealthy. Some combination of frugality and paranoia. Paranoia means, I might be wrong. This good time may end. Something unexpected may happen. Frugality means, I don't need to show off. I can live below my means. I can save for safety. If you combine both, you survive. And survival is everything. Because if you survive long enough, compounding does the rest. The danger of never having enough. Now we talk about a dangerous idea. Not knowing when to stop. The author shares the story of Rajat Gupta. He was already worth around $100 million. He had everything: status, respect, wealth, power. But he wanted more. He wanted to be a billionaire. So he committed insider trading. He was caught. He went to prison. His reputation was destroyed. He lost everything that mattered. All because he did not know the meaning of enough. Bernie Madoff. The same problem. Bernie Madoff ran a successful, legitimate investment business. He was already rich, but he wanted more, so he created a massive Ponzi scheme. He was eventually caught. He went to prison. His family suffered. His legacy was destroyed. Again, he did not know what was enough. The most difficult financial skill. The hardest financial skill is this: getting the goalpost to stop moving. When you earn more money, your expectations rise. When your neighbor buys a bigger house, you feel pressure. When your friend buys a luxury car, you want one too. The problem: there is always someone richer. Always someone more successful. If you play the comparison game, you will never win. Because the top keeps moving. The only way to win is to stop playing. Social comparison is endless. A rookie baseball player makes $500,000 per year. That sounds rich, but his teammate makes $36 million per year. Suddenly $500,000 feels small. But that $36 million player compares himself to billionaires. And billionaires compare themselves to other billionaires. Comparison never ends. It destroys happiness. What enough really means. Enough does not mean you stop growing. It means you stop risking what matters for what doesn't matter. What is truly important? Reputation, freedom, family, health, peace of mind. These are worth more than extra millions. If you risk them for more money, you are making a bad trade. The best way to build enough. The good news: you don't need crazy risks to build wealth. You need time, consistency, patience, avoiding disasters. That's it. Big lesson of part 2. Let's summarize what we learned. Compounding is the most powerful force in finance. Time matters more than high returns. Getting rich and staying rich require different skills. Survival is the foundation of wealth. The biggest risk is never knowing when to stop. Social comparison destroys satisfaction. Enough is one of the most powerful words in finance. Part 3: freedom, control, reasonable thinking and long-term survival. And the remaining core lessons of the book. Freedom is the highest form of wealth. Let me ask you something simple. Why do people really want money? Is it for big houses, luxury cars, private jets? Not really. Most people want money for one reason: to control their time. When you have money saved, you don't need to beg for a job. You don't need to tolerate a toxic boss. You don't need to panic if something goes wrong. Money gives you options, and options give you freedom. The author explains, the ability to wake up and say, I can do what I want today, is the highest dividend money pays. Freedom over your time is the real goal. Not showing off, not impressing others, but control over your life. The story of a simple man with freedom. The author shares a story of a man who worked as a parking lot attendant. He didn't earn millions, but he saved aggressively. He invested carefully. He avoided debt. When he retired, he had millions quietly invested. Nobody knew. He didn't show off, but he had something priceless: peace. He could choose how to live. Meanwhile, many executives earning 10x more had no savings. They were trapped by lifestyle expenses. Who was truly rich? The quiet saver. Money's greatest value. Money's greatest value is, it lets you say, No. You can say no to bad clients, bad jobs, bad opportunities, pressure, fear. Without savings, you are forced to say yes. And forced yes decisions are often bad decisions. Why saving matters more than income? Many people think, if I earn more, I'll be rich. But income is not wealth. Spending less than you earn is wealth. Saving is powerful because it builds independence. And here's something important. You don't need a specific reason to save. You save for things you cannot predict. Because life is unpredictable. Pandemics happen. Recessions happen. Health problems happen. Savings give you breathing room. Reasonable greater than rational. In economics, experts assume humans are rational. But humans are not computers. We are emotional. The author says, aim to be reasonable, not perfectly rational. What does that mean? A perfectly rational person might invest in the highest return asset. Never hold cash. Take maximum risk when young. But a reasonable person might accept slightly lower returns. Sleep better at night. Avoid extreme risk. And that's smarter in real life. Because if stress causes you to panic and sell everything, your rational strategy fails. Invest in a way that lets you stay invested. Room for error. One of the most powerful ideas in the book is always leave room for error. Nobody can predict the future. Not experts, not economists, not billionaires. So you must prepare for being wrong. Room for error means don't invest all your money in one thing. Don't spend every dollar you earn. Don't assume good times will last forever. Successful investors survive because they are prepared for surprises. The story of survival. Many successful investors are not geniuses. They just didn't die financially. They avoided extreme leverage, overconfidence, greed, huge risks. They survived long enough for compounding to work. Remember, you can't compound if you are wiped out. Long-term planning is harder than it looks. Here's a problem. We change over time. What you want at 20 is different from what you want at 40, and different again at 60. But when we plan for the future, we assume we'll stay the same. This is called end of history illusion. We think, this is who I am forever. But we are wrong. So be flexible. Don't lock yourself into a life that future you might hate. For example, huge debt for a lifestyle. Career paths you cannot escape. Risky investments you cannot reverse. Leave space for change. The seduction of pessimism. Bad news spreads faster than good news. Why? Because bad news is dramatic. Headlines say, market crash, economic collapse, global crisis. Good news is boring. Slow steady growth continues. But historically, the world improves slowly over time. Yes, crises happen. But progress happens too. Pessimism sounds smart. Optimism sounds naive. But long-term optimism has been correct more often. When you'll believe anything. Sometimes people believe extreme financial stories. Why? Because simple explanations are satisfying. This crash happened because of one greedy banker. This boom happened because of one genius CEO. But reality is complex. Many factors cause outcomes. When something feels too simple, be careful. The power of storytelling. We love stories. But stories hide luck. When someone becomes a billionaire, we hear, he was smart, he worked hard, he took risks. But thousands of people also worked hard and failed. Luck and timing matter. Success is a combination of skill, effort, luck, timing, environment. Never assume everything is controllable. Luck and risk are two sides of the same coin. If you want extreme success, you must accept extreme risk. For every billionaire entrepreneur, there are thousands who failed. We only see the winners. This creates survivorship bias. It makes success look easier than it is. Be humble. The best financial strategy. After all these lessons, what is the final strategy? It's surprisingly simple. Save regularly. Avoid big mistakes. Invest for the long term. Ignore short-term noise. Know what is enough. Protect your reputation and relationships. Value freedom above luxury. Leave room for error. Stay humble. Be patient. That's it. No secret formulas. No magic tricks. The real definition of wealth. Wealth is not what you see. It's not big cars, expensive watches, designer clothes. Wealth is what you don't see. It's the money saved, the investments untouched, the freedom quietly owned, Spending money shows off. Saving money builds power. The final message of the book. The psychology of money teaches one big truth. Doing well with money has little to do with how smart you are, and a lot to do with how you behave. You don't need to be a genius. You need discipline. You need patience. You need emotional control. Money is about behavior, not intelligence. Complete core lessons. Final summary. Let's close with the most powerful ideas of the entire book. Compounding needs time. Getting rich is different from staying rich. Survival is everything. Enough is powerful. Freedom is true wealth. Saving creates independence. Reasonable is better than rational. Leave room for error. Avoid comparison. Luck and risk always exist. Long-term optimism usually wins. Wealth is what you don't see.